I feel bad because it was the Paris of Middle East, and they're always mixing, doing stupid things. Uh,
Hopefully soon we are pushing, we are staying in Lebanon to push this, hopefully with the fintech and the new solutions,
yeah.
get back on the road.
So actually, since you're coming back to the main hall, we started talking to Mr. Charbel Chouet. Huh? Chouet. Well, still not bad.
Great, because it's, every time we introduced, we have some issue with the name, with the pronunciation. You got it right now.
Perfect. So Mr. Chouet,
Right.
yeah, he'll be our moderator, and he's heading the Chouet law firm. So, and especially our topic today, he's the right person to moderate it. So, what is this panel about? This panel is about regulation and governance. The main questions that the panelists will try and elaborate are: in what ways do regulated institutions support the advancement of financial technology? CBDCs, where are central banks at right now? And to lead this exciting panel, I would like to introduce Charbel Chouet from Chouet Law Firm, with a big round of applause, please.
Hello again.
And at this panel, together with us, there is, again, a really important set of panelists who will be with us. First, I would like to announce Dr. Çiğdem Ayözger Öngün, founder and managing partner at SRP Legal. With a big round of applause, please, for Dr. Çiğdem. And then our second panelist is Safia Hashisha, Senior Financial Sector Specialist at the World Bank. Nice to have you at our panel. Please take a seat. And then our other panelist is Mehdi El Akari, HPS Regional Director, Middle East. Honor to have you.
Thank you very much.
Please take a seat. And then Dr. Guy Laurent Fonjo, President of West Africa Bankers Association, WABA. And also, he'll be together with Elo Sise, Secretary General at West Africa Bankers Association, WABA. And I think we're out of chairs. And we also have Mohammed Farooq Raza. Oh no, he's not here. Okay, so we're 6. Excellent. So the panel is ready. Please take a seat, and hope it will be a fruitful panel.
So, hello everyone. Okay. I was told that he will be in the 4th panel, but you are welcome also.
Can we have another chair, please? For our panelist, Mr. Mohammed Farooq Raza, Governance and Ethics Board at the Accounting and Auditing Organization for Islamic Financial Institutions.
So, hello everyone. First of all, let me express my gratitude for this great team behind the SOFTin Space team, for this great platform. I'm truly honored to be a part of this great event. Allow me to introduce myself. I'm Charbel Chouet, the head of Chouet Law Firm. We are a Lebanese international law firm expert in fintech, blockchain, and cryptocurrency legal consultancy. I'm also here as the director of the Lebanese Association for Digital Transformation, an organization driven committed to driven the digital transformation in Lebanon and beyond. So in this panel, we will delve into two crucial topics. The first one is, in what ways do regulated institutions support the advancement of financial technology? And in the second one, CBDCs, where are the central bank at right now? So in the age of unprecedented technology progress, the financial sector finds itself at the forefront of transformation. The integration of technology into finances, commonly known as fintech, has revolutionized how we conduct transactions, access services, and manage our finance. Yet, this transformation does not occur in isolation. So in this panel, we'll embark on a journey to understand the different ways in these regulated institutions contribute to the advancement of fintech. We will explore their role as the guardian of stability and trust, their effort in creating conducive regulatory framework, and their collaboration in fintech innovators. Before we proceed, I would like to take a moment to congratulate the United Arab Emirates, particularly the Emirate of Dubai, on enacting the cryptocurrency regulating and establishing of the VARA institution. Also, I would like to extend my congratulations to the European Union on the enactment of its comprehensive crypto regulation, making it the first major jurisdiction to introduce such comprehensive crypto law. The recent enactment of the market in crypto asset, the MiCA regime, and the transfer of fund regulation in the European Parliament demonstrate the commitment to ensuring adequate regulation in the crypto space. Also, we will dive into the existing world of the central bank digital currencies, known as CBDCs. As technology continues to reshape the financial landscape, central banks worldwide are exploring the potential of CBDCs. These digital representation of fiat currency issued and regulated by central bank have the potential to transform the way we engage with money, payment, and financial services. During our discussion, we'll examine the current state of affairs regarding CBDCs, exploring where central banks stand in their exploration and implementation. We will uncover the motivation driving these initiatives, such as enhanced financial inclusion, reduced transaction cost, and increased efficiency in monetary policy. Moreover, we will analyze the challenges and considerations central banks face in designing and deploying CBDCs, including privacy, cybersecurity, and interoperability. So in 2023, we have more than 65 countries in the advanced stage of CBDC development, with over 20 central banks launching pilot programs. Notable progress has been made by 18 countries. As these countries navigate the path towards CBDCs, they are faced by important decision choosing between wholesale CBDC and retail CBDC. In conclusion, the collaboration between regulated institutions and fintech, coupled with the advent of CBDCs, represent a transformative era for the field of finance. By harnessing technology and leveraging the experience of these institutions, we can create a future that is both innovative and secure, enhancing financial services and empowering individuals and business worldwide. Thank you for your attention and hope that our exploration today will address all your questions in this field. Now, without further ado, let's move to our esteemed speaker. First, we'll start Ms. Safia Hashisha, the Senior Financial Sector Specialist at the World Bank. Mrs. Hashisha as you covered topics related to the financial sector and in particular financial stability and integrity, financial inclusion, and the digitalization of the financial sector. What can you tell us today?
Thank you very much.
Hello.
Is this working?
Yeah, it's working.
Yeah?
Yeah.
Okay. So, Safia Hashisha, Senior Financial Sector Specialist at the World Bank, covering Tunisia and Libya. From a development point of view, digital financial services are very important in terms of financial inclusion, and it's the ultimate goal for us when we develop programs that aim to enable digital financial services development by lowering costs and by also making financial services available to the poorest and in remote places. Financial innovation has made these services affordable and accessible, and are really changing the lives of people. And with the COVID pandemic, we have seen one, the importance of it, especially at the height of the pandemic, when, for example, governments needed to make social transfers, and that they didn't want to see people queuing in front of postal services and being, on top of each other at a time where social distancing was very important. We have seen how strategic these payments were in reaching in a massive way people, and in a rapid way as well. And also we have seen during COVID the acceleration in the development of these digital financial services. So in a digital era where innovation is accelerating, the regulators are facing challenges and are under enormous pressure to cover also not only a very dynamic environment, but a fast-paced one and a very diverse environment in terms of topics to be covered, from cybersecurity to RegTech to, we will talk to CBDCs, etc. So what is very important for us is to help the regulators play their role as enablers and catalysts for the private sector to develop these services, for the fintech ecosystem to be able to grow and innovate and provide these services. So there are many different ways that we have seen regulators do it. Some do it with regulatory sandboxes, some do it with innovation labs, some, we can call it different things, innovation hubs, but really at the basis of it is a dialogue, an institutional dialogue between the regulator on one hand and the innovators on the other hand. And this requires quite a bit of a shift from both. The regulators tend to be quite conservative and established and are not necessarily always very comfortable with change, and they're very risk-minded. And the innovators come from the other end of the scale. So there's work to be done on both sides of the spectrum to facilitate that dialogue. What we see at the level of the regulator is often the need to balance between inclusion on one hand, but also stability and integrity and consumer protection. So they're really trying to meet several targets at the same time. And on the end of the innovators, there's generally, and we see it because we consult quite a bit with the ecosystem of fintechs, there is a misunderstanding of the constraints that the regulators have, but also frustration with the time that it takes for regulations to adapt, to follow. So again, whether it's through a sandbox or whether it's through any other means, having an institutional dialogue between the two helps with the agility and with the comprehension on both sides. So again, the way the regulators choose to harness innovation and risk will have huge impact on their markets for the years to come. So impact on financial inclusion, of course, but impact on really the development of their financial sector, and they need to keep up with innovation. So they often also need capacity building within these within the regulators to be able to keep up with that. So these are among the things that we work on with our counterparts in different countries to try and facilitate the dialogue, enable a favorable environment for fintech development, while again taking into consideration the other objectives in terms of stability, integrity, consumer protection, etc. Thank you.
Thank you, Doctor. So now we will move to the attorney, Dr. Shidam Ongon. She's the founder of the managing partner of SRP Legal Office, headquartered in Istanbul. Dr. Ongon has 20 years of experience in technology, media and communication law, financial technologies, commercial and corporate law, competition law, and data protection. Dr. Ongon, what are you here to tell us today?
Thank you. I want to give you a snapshot about the regulatory environment in Turkey. So first of all, I would like to welcome you all distinguished speakers and the participants. Welcome to Turkey and Istanbul. So here in Turkey, the regulatory environment is the general policy and the regulatory approach in the fintech ecosystem is to ensure the establishment of regulatory infrastructure to implement financial and information security. So the security is the base aim, and then it builds up with the innovation, and it becomes the fintechs. Previously, it was the banking institutions, only the actor in the Turkish financial ecosystem. And now, for the last 10 years' time, there has been many fintech institutions in the market. Almost 100 of them are licensed from the Central Bank of Turkey. And these, the Turkish market is 85 million people, and there is a high, still a high potential of licensed institutions in the market, as well as other unlicensed institutions. So for the Turkish fintech market, we can say that there are three different types of licenses: payment services license, e-money license, and payment system license, which brings the infrastructure to the market, as well as all other innovative apps which are unlicensed and ready to serve to the licensed operators. And yes, since as Sophia mentioned, that the regulatory institutions are usually more conservative in regulating the market, and there are lots of startups and innovators ready to do the innovation. I guess the main missing part is the sandbox applications here in Turkey. Unfortunately, yet we don't have sandboxes. However, we've been working on designing a sandbox. Me personally, as the managing partner of a law firm, I'm also assistant professor in Bahçeşehir University. So I am advising to the presidency on financial and fintech regulations mainly. So we've been working on the sandbox applications and the sandbox environment, let's say. So hopefully, when the sandbox regulation come into force, it will be more, the market will be more promising for the new startups. And coming back to, as you asked about the incentives, yes, there are a couple of incentives. Some of them are fintech-based incentives. For example, very recently, the Istanbul Finance Center opened. It's not only a building or a compound, including a couple of buildings and the facilities. It also enables the companies which are operating in Istanbul Finance Center couple of incentives. And others, there are a couple of incentives in terms of technology companies. And when we look at the technology companies, usually because the fintechs has the privilege of the security, the privilege of to keen on the consumer protection rather than other technology companies, they have the advantage to get the incentives. So there are many incentives in terms of tax, income tax, withholding tax, whatever the tax name is, as well as other investment incentives. And when it comes to the regulator, all this environment has been regulated by the Turkish Central Bank. So with the new structure of the Turkish Central Bank, as you all know, we have just finalized the main elections, and now we have the first woman central bank president in Turkey. So hopefully there will be more innovation on the regulatory side. She is very promising. So it's the legal and regulatory environment, and it's not only the fintech regulations itself. Also, since everything is based on data, we cannot miss the data laws and regulations. The data protection law come into force almost it's been 7 years ago. However, it's not aligned with the EU General Data Protection Regulation, namely GDPR. So it's another challenge for the international organizations, companies to operate in Turkey. And also the presidency of digitalization, the Turkish Data Protection Authority has been working on the laws in order to comply the law with GDPR, and hopefully after the elections we will be discussing in the parliament the new data protection regulation. There will be significant change in the regulation and the law. So when there is more generous data protection law, I guess the market will be more promising for the ones who wants to invest in Turkey. However, still with the variety of people and the needs of financial services in every areas, not only in business life, also in rural areas, the Turkish market with 85 million of people, it's still promising. Thank you.
Thank you, Doctor. Thank you. And now we have Mr. Mahdi Al-Akkari, the current Regional Director for the Middle East at HPC. He is an accomplished executive with 20 years of experience in payment service and B2B business development. Mr. Mahdi, what expert recommendation across strategy, pricing, marketing, and solutioning you can give us today?
Thank you, Shabrel. Is this working?
Yeah.
Okay. Good. So I'm Mahdi Al-Akkari. I'm the Regional Director of HPS, which is a technology provider present in the Middle East, Africa, actually in the whole world, in about 90 countries, and providing services to 450 banks and financial institutions worldwide. I will try to address the conversation from the lens of a technology provider that's been here working with the banks and with the regulators for the last 27 years or 28 years, helping them implement this digital transformation. Before going into the regulatory aspects, let's look a little bit at the business. When we see all the indicators that are coming from all the analysts that look at the payments currently, it's very clear that the outlook for the payment industry and the digital payment in general is very positive. All the indicators are green. The expectation of growth is very high. Investment levels are very high. Adoption levels are very high. They say that by 2030, there will be, the digital economy will contribute to about 30% of the world GDP. So basically, we're talking about something that's going to be at the core of what everybody is doing. When we look at an environment where the indicators are all green, that creates a few things. The first thing is a very big adoption by the end users. And this is a good news for all of us. It is now very clear that people are accustomed to paying using digital means, a card, a wallet, a mobile, depending on the region, a QR code, whatever payment mean is available. People have become used to it. In Africa, USSD is another mean, for example. So the end users are using it more and more. And there are indicators that show that while the revenue that the payment is generating is growing, the revenue per transaction is going down, which basically means that there are more transactions happening, which again reinforces the fact that actually people are using digital means even in smaller things, buying a coffee or paying for the bus or whatever it is. So the demand is very strong. That's the end users. Very good news for everyone. The competition is also very strong. So banks are competing with each other to attract as many clients as they can. And fintechs are the newcomers that are challenging the status quo and creating enough move in the market in order for that service to get as interesting as possible. Of course, everybody is trying to get a piece of the pie, which, as we said, is quite significant. And that's where the role of the regulators is very important. Because the regulators look at it from a different perspective. The regulators are here, first of all, to protect the consumers, and second of all, to protect the whole economy of a given country. So they pay very much attention to the stability, to the ability of having sustainable things on the market, that the end users are not being defrauded or they do not lose their money, and so on and so forth. So let's look at it again. End users are looking for the best possible service that they can have. The players, which are the banks and the fintechs, are trying to compete to provide the best possible service to make, let's face it, as much profit as possible because they're organizations for profit. And then the regulators are here to regulate everything. So where does a payment service provider or technology provider come in play? Is actually to optimize all this story. So our aim at HPS is to make the payment as simple, as seamless, and as secure as possible. And if you look at those three terms, basically what we're trying to achieve is to optimize the situation. So if it's simple, we're making sure that the end user is actually consuming that particular service in a simple way. And also, the banks are actually providing and running those services in a simple way. If it's seamless, it's going to work all the time. It's going to require less effort for all the players to be able to comply and provide the service. And if it's secure, that's actually a basic requirement for the end user, for the banks and financial institutions, and for the regulators. So this is the reason of our existence, is how do we make all these ecosystems work and not sacrifice the core of the digitization. Let's look at it. What does the digitization bring to the end user? It brings a user experience that is simple and easy to consume. That's the most important thing. But when you bring a regulation into the perspective, a lot of the time the regulation means, or actually the implementation of the regulation, makes that user experience less seamless, more complicated, more forms to sign, more documents to provide, more people to meet, more processes to go through. Our objective is to actually adapt the regulation, or actually adapt our solutions to the regulations in such a way that the whole experience continues to be seamless. So that was one area that I wanted to talk about. The other area that we've seen in the markets, as I said, we're operating in about 90 markets in the world, including Middle East, Africa, but also Europe and Asia. We see people that, or actually central banks and regulators that are having very different philosophies about how they want to regulate. Some of them are very liberal. They will open the markets, and UAE is an example of that. They'll open the markets and let people compete. Some others are very restrictive, and Saudi Arabia is an example of that. So they would want to control all the aspects of the market. And both markets are actually thriving. And then a third type is EU, where actually the regulation has said, you know what, I'm gonna dictate my terms. If you wanna work with my citizens, you'll have to work through using those terms, but then apply it in any jurisdiction you want or any country you want, as long as you comply with this. And again, the role of a technology provider is to be able to provide the right solution for each one of the markets. So in the UAE, for example, cloud computing is an easy thing. You can use your, or you can have your payments environment in a cloud wherever it is in the world. While in Saudi Arabia, the cloud has to be in the country. And that's true for other countries like Qatar, like Turkey, as I understand. So having the right solution, the right technology solution that's able to work on a public cloud, which is hosted wherever in the world, and the same solution being able to be hosted in a given country, is the kind of effort that companies like HPS are actually making in order to adapt the solutions to each one of those countries. Okay, I still have a few points. I have a little bit of time.
A little, 2 minutes.
Okay, all right. So cloud computing regulation is coming, and it's bringing so many advantages. Actually, the cloud computing is bringing a lot of inherent advantages to the industry, and the regulations that are coming with it are allowing the banks and the financial players or the fintechs to actually adopt those technologies and take advantage of them in a way that is controlled. And as I said, our role is to make sure that these things are implemented like that. Also, the role of the regulators is to enable an ecosystem that is interoperable from one side and compatible on the other side. So we've seen initiatives. For example, in Saudi Arabia, in Ghana, there has been a national interoperable QR code system that's running on HPS solution with the collaboration of the central banks of those countries. But what they said QR code is the future, or is the present for some of the services, and we don't want different types of QR codes to proliferate in the market as the different telco operators or the different banks are adopting the technology. So they said, here is the standard of the country. So all the QR codes of the country will have this particular protocol, this particular standard, and they will run through this particular switch. And then they allowed the players to go and compete on the actual service rather than competing on the technology. That's also a direction that the central banks or the regulators can take. And the role of our company or a technology provider like us is to provide them with the means, the technology and the protocols and the support that's behind the scene that's finally enabling that particular service to the market. I think I'll stop here. Thank you.
And now we will move to Dr. Guy Laurent Fonjo. He's a seasoned banker with 23 years of experience in the African banking industry. He has a reputation for exceptional finance expertise and commitment. Mr. Guy Laurent is the current president of the Western African Banker Association, ABAO, and since you acted from 2026 to 2021 as advisor to the Guinean president and is government and the president of the Association of Banks in Guinea, what highlights can you give us today?
Okay, thank you very much, everyone. I would like to answer to the question, what are the central bank digital currency and what are the central banks today. I'll look at it from the perspective of ECOWAS. For those who don't know ECOWAS is the Economic Community of West African States. It is a community of 15 states, and within those 15 states we have 8 central banks and 250 commercial banks. So WABA is the association of those 250 commercial banks. I am the president of WABA. So when we look at what is going on as far as digital currency is concerned in Africa, you know that digital currency is not only about cryptocurrencies, it is also mobile money. And when you look at mobile money in Africa, during the past decade, you have seen a lot of progress in terms of operation, in terms of technology, and in terms of regulation. So from that perspective, we can say that regulators are far ahead in mobile money regulation. But now, if we look at other currency, cryptocurrencies, when we look at the 15 states of ECOWAS and the 8 central banks, among them, only 3 central banks have been able to work and even to launch a program regarding central bank digital currency. So the 3 banks are the central banks of West Africa. That is a central bank for 8 countries that use the CFA as currencies. And you have the Central Bank of Nigeria and the Central Bank of Ghana. Those are the ones who are working on developing a digital currencies for the central bank. So as you can see, at that level, we can conclude that the digital currency for central bank is still at its infancy level as far as the ECOWAS central banks are concerned. But nevertheless, it is important to share with you a success story that was done in Nigeria. Nigeria launched in 2021, in October 2021, the e-Naira. Actually, the currency in Nigeria is Naira. And then they launched the e-Naira with some objective. The first objective was to promote financial inclusion. And the second objective was to facilitate and to develop access to central bank's money, and also to strengthen the payment system in the country, as well as the cross-border payment system. So after the launching of that, there are some key facts that we can share with you. The first fact is that the e-Naira improved the inclusion, the financial inclusion, as we stated earlier. And also, with the e-Naira, there is no account maintenance fees, and the impact of that is that it eases the burden of customer, and also it reduces the central bank costs of producing and printing banknotes and coins. And also, it improves financial inclusion. And also, what is important to note is that with that e-Naira, the regulator was able to monitor and regulate the amount of digital currency that was in the country. And also, the regulator was able to work against volatility of e-Naira, because for each amount of digital currency, there was a physical amount of that currency available in the banks in Nigeria. But despite that success, there are some challenges that the Central Bank of Nigeria faced regarding the e-Naira. The first challenge was that there was a lack of expertise in terms of financial exclusion because most people were included and there were potential risks, framework risks. And many Nigerians feel that it was a way for the government to control their financial activities. So instead of encouraging them, it was that they use it, they took it as a way for the government to control what they are doing. And other challenge is that despite the fact that it is e-money, the inflation that is linked to the normal naira is still on. And also, the low level of literacy of people, of population of Nigeria was really an hindrance to that. And also the difficulty to access technology, especially in remote area, was also an issue. And finally, the volatility of that e-naira affect economy. I will not stop with the inflation. So by this example, you can see that it is on the way, the digital currency by central bank. And Ghana is also launching another digital currency. And also the Central Bank of West African countries, CEDEAO, is also doing the same. But I think from my perspective, from my experience, it is generally central banks are more reluctant in putting on the regulation. Actually, they follow the consumer, they follow what the commercial bank, what the customer are doing, and then they try to regulate. So we think that from the perspective of regulation and the perspective of central bank digital currency, the ECOWAS region is on the good track, and we are sure that in the near future will be among the best in financial currency and financial regulation. Thank you.
Thank you, Doctor. So interesting. Now we will move to Mr. Aliou Sezai. Mr. Sezai is the Secretary General of the West African Banker Association, WABA. As you were a member of WAMA Senior Management Team, Regional Payment and Settlement System, what else can you provide us today, Mr.?
Thank you very much. Thank you.
Yeah, it's working. Yeah, it's working.
Yeah, thank you very much. Like my colleague has mentioned, Dr. Fonyo, we are from the West African Bankers Association, WABA, which is the 15 ECOWAS member states at the level of our region. I would also like to say that our region wants to come up with a single currency by 2027. And all these issues we are doing, harmonization of payment system, harmonization of supervisory frameworks, common external tariff, all these things are done within the framework of the ECOWAS single currency. So under this item too, regulation is important. We have CBDC at its infancy in our region. Like Dr. Fonjo mentioned, Bank of Ghana and BCAO as well as Nigeria. Being at its infancy, the regulatory framework is not yet well developed, but we are doing all these things also within the framework of our single currency, and payment system, effective payment system is a roadmap item. So in terms of regulation, Nigeria is expecting to come up with a regulatory framework by 2025. A regulatory framework is expected to be up and running. Likewise, we would also like to talk a lot about some key recommendations that we think might be necessary for CBDC and their implications in terms of the conduct of monetary policy. As it is believed that as we move to implement CBDC, this might also have an impact on the key monetary policy instruments such as open market operations, the policy rate, influencing the policy rate to affect monetary policy. So CBDC might have implications on this. It might also bring some supervisory challenges, in which case then it will be necessary to review the existing monetary policy frameworks with a view to enhancing their efficacy to enhance the transmission mechanism of monetary policy. In our region, I would like to say that monetary policy, the transmission mechanism of monetary policy is actually low, in which case it means that with the advent of CBDC, it might also be critical to review these tools for efficacy, a better transmission mechanism of the monetary policies, and I'm sure it will be very critical for central banks to review the existing monetary policy tools. It is also necessary, like I don't need to mention that the central bank, one of the key roles of the central bank is price stability, but at times also growth might be inbuilt, implicit in the role of the central bank. Financial stability, of course, in which case it is necessary to review the key supervisory framework that is required within an environment of evolving CBDC implementation in the member states. So I think that it is also important to implement distributed ledger technology. I think this is also critical for transparency, efficiency, and for security too. So I think that we can say that it will be important as we move towards our objective to attain a single currency for our region in terms of building the key building blocks in terms of payment system, in terms of the common external tariff for the region. It is really important to come up with also a framework that will fit for purpose for the region as we aspire for a single currency. Mr. Chairman, I think with these few remarks, I thank you very much.
Thank you, Mr. Sizai. And now we have, last but not least, Mr. Farouk Raza, Chairman of IOFI, Governance and Ethics Board. He's also the Group CEO of IFAS, Islamic Finance Advisory, and co-founder at IFIN. He will be talking about the Sharia and corporate governance of Islamic fintech and digital Islamic financial instrument. Mr. Farouk, the stage is yours.
Thank you, and Assalamu alaikum. Having discussed the CBDCs and the payments and other things, I am going to bring another aspect from a regulatory point of view and from a governance point of view into the discussion, and that's Islamic finance. Now, I see that the majority of the delegates in this conference today are from the countries that are majority Muslim, and they will have definitely some Islamic finance players in the market, Islamic financial institutions. Even the countries like the UK, from where I come, we have plenty of financial institutions offering Islamic financial products and services. So I think you're also a little bit familiar, at least, that Islamic finance or Islamic financial products or institutions, they will require some additional layers of governance, some additional layers of disclosures, of management, of reporting and governance and so on. The reason is the very nature of Islamic finance. Now, this is something that has been dealt with over the last 20, 30 years. There are two standardization bodies, industry standardization bodies, IOFI that I'm representing here, based in Bahrain, and also IFSB, Islamic Financial Services Board, based in Malaysia and Kuala Lumpur. What are we trying to do? We are actually trying to come up with norms, with the standards that define the Sharia requirements, the governance requirements, the reporting, auditing, and accounting requirements, for these financial institutions and their operations. Now, up to here is fine, because I was just talking about, the normal, legacy banking, legacy finance. Let's come to 2023, where we have a lot of development in terms of fintechs, and we see a number of Islamic fintechs emerging across the, the world in all sorts of countries, whether they are Muslim or non-Muslim and so on. And these Islamic fintechs are changing the landscape of not only Islamic financial industry, but they are also changing the landscape of the Sharia governance as well. And why I say so? Because traditionally what has happened is that the Islamic banks or the Islamic other financial institutions like insurance companies, etc., they will typically have a Sharia board. That Sharia board, consisting of Sharia scholars specializing in their field, will approve, will certify, the products. They will certify the operations. There will be, some internal and external Sharia audits. So there is actually a Sharia governance mechanism in place as part of the overall corporate governance mechanism of the financial institution. When it comes to fintechs, where the majority of the operations are actually being conducted by technology, right? And now we are talking about things like, for example, the CBDCs, like, for example, the use of artificial intelligence, like the use of, so many other, new technologies, where things are done instantly, where, smart contracts are, for example, used, then how the aspect of Sharia governance, how the aspect of Sharia compliance will be, will be assured, right? Now, this is a matter of concern for a number of regulators, and they are grappling with the, this new challenge that they have hardly managed actually to understand what the requirements, the regulatory requirements were, for Islamic financial institutions, how the regulators, they need to deal with these institutions, and now suddenly they have a new challenge, and that's, the Islamic fintechs and the new Islamic financial instruments. So whether, a CBDC, whether, it will be accepted from a Sharia point of view or not, in a certain jurisdiction. I have had the opportunity, to work in the Western African Union, for the central bank, for, other market authority, the capital market authority as well. And I have actually experienced firsthand that how, challenging it can be to have something accepted, a financial product being accepted from a Sharia point of view because of the, the religious sensitivity related to it. So in this regard, IOFI and also IFSB, but mainly IOFI, Accounting and Auditing Organization for Islamic Financial Institutions, is developing a number of new standards. So we already have multiple standards, almost 100 standards related to Sharia, related to governance, related to accounting, ethics, and so on. And now we have actually set up a specific task force, a specific working group to deal with the matters of Islamic fintech and these Islamic new digital financial technologies, how these instruments are going to be developed, how they will be issued, how they will be managed, and how the risks associated with Sharia compliance. And let me also remind you that when I say Sharia compliance, it's not only related to the religion only. Of course, that is an issue, and that's a very big issue. But the real inherent problem is actually the issues of consumer protection, the issues of investor protection, the issues of systemic risk that an institution that causes some stir within the market, within a certain jurisdiction due to a non-compliance of Sharia, that can create. How are we going to manage that? So we are trying to establish these new standards, and I'm glad to say that the first exposure draft has already been issued, and the first standard that we have chosen is actually crowdfunding, Islamic crowdfunding, peer-to-peer lending, and that has actually covered different aspects of commercial crowdfunding, also social crowdfunding, and even philanthropic crowdfunding as well. And there are many other working groups that have also been put in place, and developing new standards to deal with these issues of artificial intelligence, robo-advisory, and these digital currencies and digital assets as well. So my 2 pence I think advice to everyone in the audience will be, when you deal, we were told this morning in the opening session that out of the 300 delegates registered for this conference, there are 150 100 banking executives, there are 150 entrepreneurs and startups and fintechs, and there are like 50 investors. That's a very good mix from around the world. And I think there is a take-home message here that you, in your whatever jurisdiction you are operating in, and there may be people who are operating in multiple jurisdictions, you will be grappling, with a number of, regulations and laws and so on and so forth, and of course infrastructure challenges. But please bear in mind that in your audience, in your customer target, target customer, if you have, the Islamic finance or Islamic fintech operators, then there are other aspects also that you shall be aware of, and you shall also, incorporate all these aspects into the regulation. If there are any regulators or, in the room, you need to develop that in the regulation. And of course, these AOFE standards, they will be very helpful, on that side. And also, the market players, they also need to understand these intricacies and these sensitivities, because they will help you do a much better business with a much lower risk if you fully understand these aspects. So if there is anything that I can be of, more detail with, I will be able to help you with after the session, as we have limited time. Thank you.
Thank you, Mr. Farouk. Thank you for all our speakers. So now, if anyone has any question, we'll be happy to answer them. Please. We need a micro there. Please, a microphone. Yeah, 1 minute. We need a microphone, please.
Naaman al-Bouri. Mrs. Safiya, you talked about the dilemma between inclusiveness and consumer protectionism. And this is something obviously we see apparent in Libya through certain circulars and regulations that are being put. As World Bank, how do you suggest to the regulators to deal with it? And where, because if you consider or give more weight to consumer protectionism, you're killing innovation. And you're killing inclusiveness in the market. So what is your, as World Bank, what is your advice to the regulators in that sense? And also today, we are seeing today in Libya a tendency of going back into a monopolistic approach by the regulators in Libya, in fear of losing control of state enterprises. And there's also a problem of sole players in the market rather than having a market open to all the players. I also have a question for Mr. Mehdi. As a technology provider and having to deal with regulators, and you said you as a technology provider, you provide the technology that helps regulators implement their regulations. But when you start looking at regulations that are more of a tightening regulations, how does that impact you being a technology provider, an innovation provider? And how do you, give us, if you can share with us some examples. And again, I refer to a country where I come from, where we are seeing a regulatory framework that is being drafted today that is going to be destructive to innovation. So if we can share with us some of your experiences and how best to deal with it before we fall into the mistakes of others. Thanks.
Thank you, Norman. The first question was about how do we reach a balance between the objectives of financial inclusion on one hand, and then stability, integrity, and consumer protection on the other. And the answer is that there is no clear solution. It's a very thin line. It's very oftentimes an iterative process. It is also what us as an institution, but also other institutions, I think to the FATF, in terms of AML and CFT regulation and other, is really to have a risk-based approach. And so to try and tailor the requirements to mitigate the risks to the actual risk assessment. So obviously from case to case, this can differ. One example that has been, for example, you were mentioning Libya. One example that has been brought to our attention is the quite restrictive regulation that was put in place by the regulator on the financing of non-profit organization. But then again, on the other hand, Libya, like Tunisia, like other countries, were at certain point on the gray list of the FATF. And so it's an equilibrium. You have to regulate. The risks are out there, and sometimes they have a systemic impact. And at the same time, you need to, be a catalyzer and enable a favorable environment. And it's no easy task. So I don't know if that answers the question, but basically it's an iterative process. On the second question was on the role of the state in the economy and in the financial sector in particular. We look at the World Bank. We look a little bit at the entire region, and the question of the role of the state in the financial sector is a question that is on the table within the institution throughout the region. The region is in a transition phase, and the transition is also reflected in actually the role that the state needs to play in the economy. So it's no secret that the World Bank position is that the state plays an enabler role. But then from one country to another country, depending from where you started, that transition, I mean, different countries are at different levels. The objective is really to reach a point where to maximize competition and therefore improve service, improve growth, improve the consumer experience. The state is a facilitator and not an active major player in the sectors. That being said, obviously it's not that easy, and then there are other considerations. Again, we really try and look at the trends, and depending of where the starting point was to really help evolve towards an objective of a more balanced roles between the public and the private sectors.
Okay, I'll start my answer, and I'll try to be quick, by describing a country that is extremely restrictive in terms of regulations. And in that particular country, licenses for banking are very limited. Or actually, they stopped issuing licenses a long time ago. And they regulate everything. So they regulate how the POS network works. They regulate every single product that a bank is commercializing has to be tested by the central bank, by the personnel of the central bank. So they'll send someone, you've designed your prepaid card or your credit card, you want to launch it in the market, you're not allowed to do it before someone from the central bank comes and tests it. And then they've got all the rules and regulations. It's one of the most intrusive and restrictive regulation in the whole Middle East and Africa. And I'm describing Saudi Arabia. Yet, Saudi Arabia have managed to have 1.3 million POS terminals in the market in the last few years. So that means, and there are examples of the exact opposite. So they don't at all regulate, and still the market is evolving. The big lesson here, we can be against a particular regulation, or we can be not favorable or not of the same opinion as a regulator when they try to tighten up an environment. And if you are Apple, for example, you can enforce things on the regulators if you are a huge organization like that. We are HPS. We choose a different type of approach. The approach is to adapt to the market. Basically, if you have the right solution and spend enough energy to understand what the market needs and what are the regulations, and you adapt your solutions, your technology, your capabilities to the requirement of that particular market, there is a mean for you to thrive even in a market that's very restrictive. And if you spend your energy resisting regulation that you can't actually change or influence sufficiently to change, then the only option that's left is actually to adapt to the regulation. And your objective, and our objective, is just to optimize as much as possible. So if the regulation will not allow your services to be as shiny as they could be without that particular regulation, then be it. That's the constraint that you're dealing with. But you get as far as you can. Trying to resist the regulation is going to be a tricky, I would say, strategy, especially if you're not as strong as the regulator.
Do we still have time? Okay. Sorry, I would like to apologize. If anyone has other questions, you can meet our speakers in their booth and ask all the questions needed. Thank you for your time. Thank you, our speakers.
Thank you so much for your valuable inputs. Thank you, sir.